Yeah. Hi, guys and girls. I'm Jose, one of the co-founders at Delphi Digital. We have a research firm, an incubator, and a venture fund, and yeah, investors in a lot of stuff that you guys would have heard of. Diogo, go ahead.
Yeah, I can start off. So I have three main hats. I founded a company called Anchorage Digital, which is still the only federally chartered bank in the US. It's a bank that helps institutions store and use cryptocurrencies. Pretty big at this point, maybe too big. Then I'm also a general partner at a firm called Haun Ventures, which is a $1.5 billion venture firm, $500 million early stage, $1 billion growth stage. We do investments from $3 million to $100 million in crypto companies. And then finally, I'm also the chairman of the Foundation and help out as much as I can there. So those are my three hats.
Nice. So I want to start with stablecoins. You guys have been super active in the stablecoin space. A while ago, you were helping me with one of our projects we were incubating, and I was really impressed with the amount of knowledge you guys have on the stablecoin space and mapping out. A lot of people are hearing like a lot of excitement about it, but maybe you can tell us like what are the most exciting things you've been seeing in the stablecoin world. Like you can talk about it as things that are already getting adoption and also things that are happening under the surface that people will maybe start seeing in 2026.
So I can run you how I got interested in it, why we say that we're good in stablecoins and why we were in it before it was popular, and I guess what the current status is and where we're going. So those four things. So you have to look at my career as I was very early at Square, which was a payments company. And so payments integration infrastructure. Then I actually am a security engineer by trade. So I love architecture and like putting actually things together as an engineer. And then finally, I literally started a federal bank, right? I have the same charter in the United States as JP Morgan Chase or BlackRock. That bank charter, I created one for crypto. And so that angle got me the payments angle, which has been broken infrastructure for a long time, the engineering architectural angle, and the banking rails. That's how I've always had affinity towards, as soon as stablecoins came out, just better dollar rails. In terms of validation, we actually were early stage investors. I was an angel, and Haun Ventures was an investor in Bridge that got sold for $1.1 billion to Stripe, which was really the acquisition that kicked off all of this excitement around stablecoins. Was this acquisition. We were also investors in Privy, which was this, wallet architecture that was actually sponsoring and supporting a lot of stablecoin use cases, also bought by Stripe for $500 million. And I also led the round of BVNK, which is probably the world's largest orchestrator in terms of revenue and volume, which gives us a lot of insight into what's actually happening with stablecoins and what actual institutions are doing with it. We also have a bunch of other investments, and we're obviously very close to issuers. And Anchorage itself is the first Genius Act compliant issuer. So you've all heard about Genius Act. Genius Act is essentially this United States law that says what qualifies as a Genius Act stablecoin, the backing, et cetera. And Anchorage issues stablecoins. So USTB is actually our first one in the first Genius Act compliant.
The Athena partnership, right?
Athena partnership. Athena actually issues a compliant stablecoin with it. Why were we the first ones? Well, because you need a bank as an issuer, a federal bank as an issuer for it to actually be stablecoin Genius Act compliant. So that's how we got interested. That's my credentialing. In terms of what's happening right now, I think we should all be the most excited about stablecoins because it gives us as a crypto community the single best speaking track to large institutions as to why we're building something credible and meaningful and that has legitimate utility. Because for the longest time, I think we've been struggling in the space with stuff that just institutions don't understand. You talked about sovereign resistant store of value. Nobody could grok that, you had to talk about money, and then once you start talking about money, you have to talk about philosophy and politics, and that's extremely hard to explain. Stablecoins are just obviously amazing because there is real-world utility, even if they're not cheaper, which, by the way, I'll be the first one to admit that in many of the rails, stablecoins are actually not cheaper than the current rails that we have, but they have all sorts of characteristics that actually are in many dimensions better than what we currently have. So the things that are happening are, on the consumer angle, owning Bitcoin as a store of value that is sovereign resistant is moved to holding stablecoins. Venezuela is in the news. It's actually one of the countries that has the highest adoption of stablecoins, specifically USDT, because they want to escape the hyperinflation, which I think in 2023 was 10 million% of inflation. 10 million%. Now, we're discussing like inflation rates of like 2 to 3%, and these guys were in the 10 million category, which is absolutely ridiculous and hilarious. And then what's coming next? The next wave right now that is growing the most is clearly the institutional portion of stablecoins. And these are remittances, pay-ins, payouts. You'll see this bucket that is not the retail bucket.
Sorry, what was the first bucket?
The first bucket is the retail, which is holding a stablecoin as a store of value reserve. That was one of the exciting things. We've been talking about crypto forever, about how crypto is going to, I guess we use the word revolutionize and, bank the underbanked and be like new financial rails that everybody can access to. That's finally true. It is absolutely true. And it grew a lot. But that is actually not the biggest portion of the pie right now. The biggest portion of the pie, both bigger in absolute terms and growing the fastest, is actually the institutional adoption. And you should be extremely excited about it, because while on the retail side, the use case is somehow, skirting local regulations, making sure KYC is not necessary when you have a self-custodial wallet, and so there's friction there. On the institutional side, it's pure revenue and dollars based. There's a capitalistic interest alignment in everybody using stablecoins for, say, Deal, paying contractors all over the world with stablecoins much cheaper, or remote.com. EORs are using this.
That would be in the second bucket, like the remittances bucket?
It's the remittances bucket. I think it's an individual bucket that is lower than institutions and lower than just holding, but it's also like, I would say, like in terms of size, it's growing, but it's not growing as fast as the institutional bucket.
Do you have stats around, so the first bucket you said is retail users holding stablecoins.
That's right.
And do you have stats around how many users around the world are holding stablecoins nowadays?
These stats are extremely hard because obviously, as you guys know, like on-chain data is extremely hard to get. And if you have a self-custodial wallet, how the heck do you know? But the latest reports, there's a really good report by Dragonfly with one of our portfolio companies, Artemis, and actually coalesces data of many other portfolio companies like BVNK, et cetera, where they look at actually the activity. Those are the numbers that I'm quoting. It's a report from last year, 2025, that shows that about 20% of the use case is the retail. Remittance is a little bit lower than that, and institutions is over 20% and growing extremely fast. If you see the portion of the pie is actually increased quite dramatically, almost doubled year on year in terms of use case. Then there's also the payment cards, which is an interesting use case. It's both a mix of retail and consumer. You have a stablecoin, but a stablecoin lives on blockchain, does not live on traditional rails. You cannot have a blockchain and a Visa credential for me to pay for the coffee. And Visa is actually the broker between the two worlds. And so charge cards are one of the most popular use cases in crypto right now, which is your wallet allows you to prepay or pre-deposit a bunch of USDC or USDT or stablecoins, and then the charge card actually takes it directly in stablecoins and then settles it with the banks. That's really exciting because now you have a self-custodial wallet that can actually pay for things on a Visa credential. So charge cards are growing extremely fast, but it's not just retail adoption, it's also institutions. Somebody in Dubai, for example, paying for Starlink. This is one of the most common use cases, is these cross-border payments that historically were extremely hard. They couldn't get American dollar cards to pay for Starlink, and Starlink does not accept dirhams, for example, or would not accept reais or whatever. And so these cross-border transactions are actually a really exciting thing with companies like Rain, companies like Red.Pay. I mean, talk about crazy product market fit and crazy growth. I've never seen anything like these companies' growth, in particular Red.Pay, is just insane amount of growth in terms of the actual user adoption. So lots of stuff is happening here.
That's cool. And so everyone agrees stablecoins are growing. You can see it in the headline stats. You can see it in all the stuff you just mentioned. Crypto people get excited about it. It's one of the only secular growth stories we have, in the sense that it's not correlated with the speculation cycle, right? Like the Bitcoin price and the 4-year cycle, whatever you might believe about that. The concern crypto people have is that, or some crypto people have, is that the value isn't really accruing to any of the public networks or public tokens, right? And you're kind of seeing it with the launch of Tempo, right, which is kind of backed by Paradigm and Stripe, and just Stripe getting into the space generally and eating a lot of the value. So I guess, where do you think the value accrues with the growth of stablecoins? If stablecoins are at, I don't know, $1 trillion market cap by the end of next year, probably ambitious, but what do you think, who do you think the big winners are?
Okay, so two sets of the questions. I think one is the concern that I'm going to address, which is it doesn't accrue value to crypto-specific companies. And I'm like, it is possible that it doesn't. But why am I concerned? I shouldn't be concerned. We should all be excited that there's a new money rail that you can build new companies on, whether you call it crypto or not. I don't care. But
people want to buy a token. People want to buy a token that goes up as stablecoin to succeed, right?
Well, yes. People want that. They want Ethereum to really be the underlying rails, or Solana to accrue value, or whatever blockchain you're actually using, like Near, and you want like transaction fees, and you want these economic engines to actually be successful for the application. And many people are attempting to do things like that, and I think we've already seen like this new wave of like revenue focus, kind of like accrue much more value to the actual tokens underlying. But I think let's take the meta level view, which is as a crypto ecosystem, we're not here just pump underlying layer 1 tokens. We're here to actually create better underlying rails so that other people, including ourselves, can build companies on top of. And before stablecoins, regardless of whether it accrues value to layer 1s or not, you had a really hard time getting approval to get access to the Fedwires of the world and Swifts of the world and like payment rails, and now you have a much easier time. And so you as entrepreneurs and as crypto entrepreneurs should be extremely happy of the fact that Stripe is creating a layer 1 and exists, because what they're doing is helping us. They're helping us put programmable money on chain. They're pushing with their institutional heft the programmability aspects, the transparency aspects, the indelible ledger aspects, all of these things that are core. Yes, it's not a public blockchain, but there's a lot of things that are core about our ethos that are now being pushed by massive institutions. And I think that's just net good. Is there a possibility that they end up accruing all the value and then other things don't? Yes. I actually think it's probably 20 to 30% chance that's actually like the end state of the world. The likelihood is that it's actually a split. And there's a lot of use cases that Stripe will not want to have on their rails. And there's lots of use cases. You saw Vitalik's latest post about like the element of like economic freedom being one of the actual guiding stars and directions, not the optimization of the latency of the blockchain. That is an anti-institutional rail. Somebody whose company has a CEO that can be arrested cannot actually like be on the extreme end of economic freedom as a principle. They just can't, because they'll go to jail somewhere. And so these two things are actually on opposite ends of the spectrum, and I still think there's a lot of value to be captured, even if they're extremely successful, which 20 to 30% chance that that's actually the case. In terms of value capture, it's open for seeing where it actually is capturing. Right now, it's a pyramid. The issuers are making all the money, Tether, Circle, etc. On top of them, you have the routers, which are BVNKs, the bridges, etc. They're capturing some of the value.
So what do the routers do?
So the routers, well, the stack is pretty fat, depends on how you look at it. But right now, the most basic portion of a router is to do fiat to crypto fiat, and do so in a compliant manner that is extremely fast, and that overlays across all blockchains, such that you don't have to, as an institution, care about it. I care about getting $1 across a border into my client. I don't care what type of wallet they have. I don't care what type of blockchain they're on. I want to get $1 or a real from here to there in a very cheap manner, in a very fast manner, with finality, with programmability. That is the core of it. The reality is that there's a bunch of like value-added services that they're going to add.
Bridge would be one of the routers here.
Bridge would be one of the routers. The revenue is growing extremely fast.
So it's like I have dollars in my bank account. I want to send stablecoins to someone in Latin America or something. Bridge just handles it for me. I don't have to worry about it.
A concrete example of something that is growing extremely fast right now is like EOR payouts. You want to hire contractors all over the world. You do not want to open bank accounts in random countries. You do not want to actually create companies in random countries, because now your cost just ballooned by 100x. So wouldn't it be great for BUIDL to have a rail that actually allows them to programmatically send the dollars on a regular basis, and the only thing that the remote contractor, individual, company has to do is insert wallet here or connect to wallet here, whatever their wallet, whatever their blockchain. They'll deal with the rest. And technically the last mile delivery is left to the observer. They can actually do it and turn it into dollars too, and it arrives in a bank account. But ultimately, it's this superpower of like, I don't care which country you're in. You want dollar, you want euro. I can take any origin in any destination, and with an API, get it done. That, funny enough, didn't exist before, or didn't exist at a price that allowed you to do it. And then the price matters deeply when you're doing small payments or when you're doing regular payments. And so there's new business models coming in, there's new products that you can launch that you couldn't launch before. So that's a very specific enterprise use case that is using these middle routers, and for which the routers capture value because there's real utility. They're taking on liability. In many cases, they're actually taking the risk of, say, converting a stablecoin to another stablecoin. Or they're taking the FX risk, or they're taking some settlement risk, because these things are not actually instant, so they're taking a little bit of settlement risk. So there's a lot of risk that they're taking on. If there's risk, there's money to be made. And then on top of the pyramid, so we have issuers, we have routers, and then you have the money apps. The money apps are money that, the new Venmo, stablecoin Venmo, whatever, Sling, Money, all of these really cool apps on top. And right now, they capture the least amount of value. But as time goes on, what we're seeing is an inversion of the pyramid. The bottom layer is being squeezed. You already see it.
Closest to the layer that's closest to the user traditionally captures most of the value, right? Which is basically the neobanks that you're talking about.
And it will invert. In the middle, we'll still capture value, and we'll have to go deeper and offer more services that are not just like infrastructure services, but the capture of the value, we see it's on the user base and the applications.
Yeah, you wouldn't expect the issuer status quo to be sustainable, right? For these issuers to continue to have, the greatest businesses in the world, basically in the case of Tether, like people will expect to be paid the yield of the underlying dollar, right? You're kind of seeing that already with Athena Pay and some of the other things coming to market.
And one of the things that you said is like, stablecoins are the only secular trend. I don't know if that's true, and we should talk about like how RWAs are actually, stablecoins are RWAs, but one of the things that is cool is that in crypto, if you have a basket of crypto investments, right now, you're both investing in something that is going to win, stablecoins, as the dollar gains in value and continues being a dominant currency, and you have a thing that will gain if the dollar reduces importance and the world goes to crap, right? So you have actually a basket. Investing in crypto is really interesting because you have both secular trends of like anti-privacy, you have secular trends of like obviously money printing and high inflation, and you have a secular trend of like, faster payments, more. It's kind of an interesting basket. We have everything.
And I had one more question, but I think we can move on to RWAs and maybe ask it after the talk. So you've said that tokenizing money opens up the possibility, that opens the door to tokenizing everything else. Why is that?
So the way to view this is, if you think about, I hate the term RWAs because, RWAs are real world assets. And
what are RWAs? Maybe you can define them as well to start.
Well, first and foremost, I don't think there's a fake world, so I don't know what FWAs would be. And the reality is that what we're trying to distinguish with real world assets is assets that are not natively digital already, but the actual analogy and the name falls apart, because when we were talking about T-bills being one of the most obvious examples of RWAs, they're already digital in nature. But anyway, an RWA as a conceptual version is, can we represent on-chain something that lives off-chain? And so we create buckets where we put things that don't traditionally live on-chain, real estate, T-bills, all sorts of like credit, all sorts of like traditional products that live in the domain of traditional finance. You create a little bucket, and we can talk about like what this bucket looks like. There's better buckets, worse buckets, and then you put that representation on-chain. And the reality is that under this description, stablecoins are RWAs, because of course they are. They are a dollar that is put in a little package that is then put on-chain. And the reason why I think these things are actually just a continuum, dollar is the easiest thing to put on-chain. Number one is the thing that has the most demand internationally. It's the thing that is the most useful, that has been the most broken historically, has been payments cross borders, and that there's the most liquidity for and the most ease of actually getting as an RWA. A dollar is a dollar. It's very easy for me to get a backing and represent a dollar. These things don't change in value. There's a Federal Reserve. And so dollars are very easy things to containerize and then put on chain. That's why they were the first ones. But the technology that we use to create stablecoins is 80 to 90% there of the technology that we need to put anything else into the wrapper. Because again, the container that we're putting on chain is totally generic. And so going from stablecoins on chain, which we call, from dollars on chain, which we call stablecoins, to T-bills on chain, which we're calling RWAs, is very close. And in fact, if you look at the orchestrators and the routers, the technical integration, the technical APIs that they're actually using to move these things around are exactly the same. So for a router to move dollar on chain is the same thing to move a T-bill on chain. That is the same thing technically to move kind of like some real estate ownership on chain. Obviously, there's very different things that are inside of these buckets, and they get it more and more complex. But 80% of the actual infrastructure that is being built for stablecoins can be reused for all these different things. Mm-hmm. And so really it's a gateway, right? It's a series of steps. The success of stablecoins is bringing us closer to the success of everything else that is actually going to come. So that's what RWAs are, and that's why stablecoins, number one, are RWAs, and why it's sort of inevitable. And what we don't know is it's much harder to put a house on chain. In America, you have 50 states. All of them have different registrations and registries for houses. Many states have multiple registries for houses. The final mile of understanding real ownership of the house in the deed, in everything that comes to it. And the wrapper that you didn't put on chain is actually extremely risky. There's a lot of counterparty risk. And so we've been wanting to put real estate on chain for a long time, and it's been really extremely hard because of this fact. And so what comes first on chain after dollars? Well, T-bills, things that are actually still dollars, but basically dollars with a yield. Then after that, you obviously have credit. Credit looks like a T-bill. It has more underwriting and risk in this packaging, has more things inside, but it behaves the same. Then after that, you have equities, which actually also have a package that looks very similar. Then after that, you have bonds. And then after that, yeah, you kind of like extend and continue to increase the aperture of these things. But if something is digital already, which stocks and bonds and credit are, then it's very easy for us to put it on chain. And everything that is not digital in nature are going to be the hardest things of the funnel to kind of like get through.
Okay, you kind of answered my next. So you think that the next, I was going to ask you, what do you think are the categories of RWAs that go on chain next?
It's a matter of, is it digital
without
already?
counting T-bills, and I guess stocks are already on chain, so maybe no T-bills or stocks.
I think credit is obviously the big one. It's like the credit
Like
markets are
private credit,
huge.
or-
Yeah, private credit. Private credit markets are huge. They generally have been, when it is in the United States, private credit is actually pretty liquid, but they're not accessible. The same way that the stock market is not accessible to somebody in Venezuela or somebody in South America, and not even the dollar was accessible. So think about it from a point of view of accessibility. We're making these things accessible. And private credit is a pretty exciting, growing category of yield generation, and something that very wealthy individuals have always have access to. Now, whether the private credit that is coming on chain is the good private credit that we want to invest in, that's a different matter altogether. But private credit is an obvious one because it's looking for more demand, and it is a wrapper that we understand. And if it's very transparent in terms of like how do you do the risk underwriting, it's an obvious one that can actually like be put on chain, and it's growing extremely fast.
And what's the use case? Like people just want on-chain yield because the yields are going to be lower than I guess what you can get on Pendle, PT, or something like this.
Not necessarily. Not necessarily. No, the yields are. I mean,
it depends on the risk, yeah. But and
from 1 to 50% or 100%. I mean, you're taking more and more risk, right?
Mm-hmm.
But you're taking traditional finance risk instead of smart contract risk and like AMM risk or whatever risk that you're taking.
And it would be like all this stuff would be KYC gated on some kind of like security token standard.
So that's where the rubber meets the road. So there's a company called Superstate that we're investors in that is really interesting. They're trying to do real on-chain IPOs. Right now, stocks on-chain are actually not real stocks. You're not the real owner of the underlying stock. For example, you can't vote on governance. If you have a Tesla stock on one of these apps that has them on-chain, you can't actually vote for Elon Musk's pay package because you are not the actual legal owner of the stock. And so what these companies are trying to do, like Superstate, is can you actually have an on-chain representation of a stock that actually gives you all the rights? It's literally like written in some ledger that you are the actual ultimate beneficial owner of the stock, and thus you can actually vote for Elon Musk's pay package, for or against, whatever you want. But that does not exist right now, and they're starting to create it. There's a couple of stocks that they've been able to issue it, but what we're trying to get is the packaging of the traditional finance has to be much closer to the actual wrapper that we had for it to be real. And it's all about like, can we also access traditional finance from crypto? And the question is, how close can we get it? And right now, we're playing.
What do you say to people who actually would say the opposite, that like most people don't care about voting their stock, they just want sort of the price exposure portion, and in that sense, maybe perps or like equity perps give you everything that you actually want, which is the price exposure, and they're much easier because you don't have to have like a million versions of the same stock. You have all the problem that you have with stablecoins on a new chain, right? Where there's like a million different stablecoins, no liquidity.
Beautiful. And by the way, if we go into a world where people want exposure to perps, fantastic, but perps are not the underlying. We've seen the consequences of you not owning spot and you not owning the actual underlying and you owning an actual synthetic product. It's still a synthetic product. It has advantages. And it may be, and by the way, there's derivatives in traditional world that are actually much higher multiples of the underlying spot trading. But who's trading spot and who thinks they actually own something, they should actually own it and not have this counterparty risk of some SPV that is wrapping the ownership and then the owner of the SPV is actually the owner of this. We have to fix that. And maybe it will be that perps are just 10x the volume of the underlying stocks, but the stocks still have to exist. And wouldn't it be much better for perps to actually have as collateral the on-chain stock that doesn't have this counterparty risk? That's much, much better as an outcome for the industry. So the industry needs this. We need this infrastructure because it's much better for us. There will be less points at which this will all break. And we are in a narrative of like telling everybody that DeFi is better and crypto is better and it's transparent and it's more fair and more et cetera. And the way that we bring stocks on chain is the opposite. It's like, it's opaque, it's wrapped, and it doesn't actually qualify the underlying. So these problems have to be.
Definitely agree with that. Thanks very much for your time. Appreciate it. We've run out of time. If you have more questions, we'll be around afterwards to answer them.
Thank you.
Cheers.
Right.